In today's video, I'm going to go over everything you need to know about real estate investing, the complete guide, even if it's your first rodeo. And if you're new to my channel, my name is Meredith. I'm a mortgage broker and I put out educational videos every single week, tips on home buying, tips on home ownership. So make sure you hit that subscribe button so you get notified every time I put a video out. Now let's get into it. So there are only two ways to enter the real estate investing. Either one, you live in the property and rent out the other unit or rooms, which is called house hacking, or you buy it strictly as a rental and never live there, which is going to be considered a straight investment purchase. And throughout this video, I'll show you how each step changes depending on which path you choose so that you can decide which one is best for you. So step number one is preparing your own down payment funds. So before you look at properties, you need to understand what it costs to get in. So for an investment property, most lenders want anywhere from 15 to 20% down. And on a $400,000 property, that means anywhere from 60 to 80K plus closing costs and cash reserves. And if you don't have that yet, you can still start through using the house hacking technique because FHA allows 3.5% down even on a duplex, triplex, or fourplex, and if you live there for 1 year. And that's how many investors get in the game when they don't have the 20% saved. Now, you'll also need reserves. Usually they want anywhere from 2 to 6 months of mortgage payments to protect you from repairs, vacancies, or delays. And smart investors set that aside anyways before buying, not after. So when it comes to house hacking, you'll need anywhere from 3.5% to 5% down, but you must live there. When it comes to an investment purchase, you'll need anywhere from 15 to 20% down, but you can rent it out immediately. Now, a common mistake I see a lot of people making is they only save enough for the down payment and they forget about closing costs and reserves. Also, buying with no cash buffer and then panicking when repairs hit, because it will, and assuming that FHA is always cheaper long-term without factoring in future refinance strategy. So what you want to do is you can use FHA or 5% conventional to enter sooner with less cash. Then you also can ask for a seller credit to reduce your closing cost. And you'll want to run worst case scenarios so you're never caught off guard. Now, if you think down payment is the only financial step that you need to understand before investing, the very next step is where most investors get rejected entirely, and it has nothing to do with cash, so let's go into it. So your credit score directly impacts your interest rate, approval, and long-term profit, and a higher score means cheaper money overall. So you'll want to aim for at least a 700 plus, and ideally a 740 for the best terms. And when it comes to house hacking, using an FHA loan, you can go down to a 620 credit score, in some cases even lower, but you'll require a lot larger down payment. And when it comes to an investment loans, they normally want a 700 plus, or they're going to charge you a lot higher rates if you have a lower credit score. So what you don't want to do is you don't want to start opening up new credit right before applying. You also don't want to start closing old accounts and losing credit age. You also don't want to ignore small collections that can kill approvals. So what you'll want to do instead is you can start paying down cards before the statement date, so it lowers your utilization reports. Also, you can become an authorized user on a seasoned account or use a rapid rescore if you're close to a better tier. And even with perfect credit, you can still get denied if you don't talk to lenders at the wrong time or in the wrong order. So this next step is where most beginners sabotage their approvals before they even apply. Before we go over that, make sure you hit that subscribe button if you're planning to buy a house in 2025 or 2026. Now, most beginners either delay talking to a lender too long or they apply before they really understand their numbers. And at this step, you're not applying, you're simply just gathering a strategy. So you want to ask lenders, based on your income and credit, what range could I qualify for? Which loan types would fit me best? Would it be best if I do an FHA, conventional, or even explore DSCR options? Also, you'll want to ask them, what documentation would you need from me? And this step will give you a clear financial target before shopping. So with house hackers, whenever you're doing this strategy, you would want to work with lenders who really understand all the occupancy rules and low down payment programs. And with investors, you would really want to work with lenders that are familiar with like DSCR options, portfolio, or investment specific loans. What you don't want to do is you don't want to let multiple lenders run your credit early. You also don't want to not compare loan terms or options or skipping the pre-approval entirely and just losing your negotiation power. So what you'll want to do instead is talk to 2 to 3 lenders early just for strategy. Use these quotes to shape your search budget so you have a better idea. and let lenders tell you what to fix before applying. It's really like free coaching. And even if a lender approves you, you can still buy the wrong type of property and destroy your cash flow. So this next step determines whether your investment makes money or bleeds your cash flow. So there's no single right type of property to start with. The right choice depends on your strategy, experience, and cash position. So you can buy a single family home, a duplex, triplex, or fourplex, or even a small multi-unit building. Now, multi-units typically produce more income, but may require more management and more repairs. Now, condos often look beginner-friendly, but HOA fees and restrictions can eat into your profit and sometimes limit rentals entirely. And it's not ideal for first-time investments. So when it comes to the house hacking, either duplex or triplex are really ideal. You live in one unit, you rent the others, and your tenants can help pay for the mortgage. Now, for the investment side, look for single-family homes or multi-units that's high in demand, rental areas with proven rent history. Now, what you don't want to do is you don't want to choose a property that's based on finishes or emotions instead of actual numbers. Also, buying in an HOA community can restrict or ban rentals entirely, also ignoring maintenance burdens, more units, more coordination if it's self-managed. So what you'll want to do is target properties with under market rents that you can raise later. Also, you want to work with an agent who understands investor-friendly neighborhoods, rent demands, and landlord laws. Also, start with simple property that teaches you. The goal is to get in, not to buy perfect, but choosing a property that isn't enough. The numbers matter. The next step is where investors even make a duplex, triplex, or fourplex on paper or realize too late that the deal never worked to begin with. So you'll want to conduct initial property search. So now that you'll begin to analyzing deals, not shopping emotionally. And a good investment must cash flow. So cash flow means that the rent exceeds all expenses. So that will include the mortgage, taxes, insurance, HOA, if you have any maintenance, or also vacancy buffer. So if the rent is $3,000 a month and the total expenses are $2,500, that leaves $500 per month in positive cash flow. And you can use tools like Zillow or Redfin to compare your rent ranges and your comps. And when it comes to doing the house hacking strategy, you want to look for something that's livable, that will rent well once you move out. When it comes to the investment strategy, you want to focus on ROI, capture rate, which is a percentage return that you'll own if you paid cash in a neighborhood that has a growth trend. Now, what you don't want to do is you're only analyzing one property instead of multiple, overestimating rent and ignore expenses. Also, you don't want to ignore neighborhood crime, school zones, or tenant demand. What you'll want to do is you'll want to target areas where rents are rising faster than value add-ons, which is like cosmetic updates, under market rents, poor management. Now, the worst home in the best neighborhood still builds the most equity. And even if the deal pencils out on paper, most buyers still lose the property because they aren't positioned to move. Then the next step is what separates browsers from actual investors. So once you have a realistic price range and understand the numbers, now it's time to formally get pre-approved. So this will include a hard credit pull, income verification, and documentation review. Now, pre-approval gives you negotiating power and allows you to act quickly when a good deal appears. So when it comes to house hacking, you're going to get a lot lower down payment. It's easier to qualify, but remember, you must live there for at least 1 year. When it comes to investors, you're going to have a little bit higher standards, larger reserves, also a larger down payment, and the property's rental projections may be considered. Now, what you don't want to do is whenever you're getting pre-approved, you don't want to submit incomplete documents. That will delay your approval. You also don't want to shop without a pre-approval letter. Also, letting pre-approvals expire, which is usually good for anywhere from 60 to 90 days. Now, what you'll want to do instead is use your pre-approval to negotiate strong offers. Ask the lender if projected rental income can count towards your approval, and also compare offers. A difference of even a quarter of a point adds up over years. So being approved does not mean you'll actually win the deal, and most people blow it in the offer stage. So the next step is where experienced investors will beat first times every time. So once you find a property that meets your criteria and numbers, it's time to write the offer. So you'll always want to include inspection and financing contingencies for protection. Never waive your due diligence period as a new investor. So when it comes to the house hacking, you want to look for houses that have a favorable layout with privacy and that's easy rentability. When it comes to the investors, look for favor financial stability, clean books, rent history, low repair risk. And what you don't want to do during this process is you don't want to get emotionally attached and start to overpay. Also, you don't want to start removing contingencies just to win or not checking comps before offering. What you want to do instead is strengthen the offers with a faster closing or a large earnest money deposit instead of a higher price. You can also use inspection findings to negotiate credits rather than just walking away too early. Also, build relationships with agents who sees deals before the public, but winning the offer doesn't mean you own the actual assets, and plenty of deals die after expected. So the next step is where loan collapse if you're not disciplined. So inspections protect you from buying a financial disaster. You want to hire a qualified inspector and review the report carefully. So when it comes to the house hacking sites, you want to focus on safety and livability because you will live there for at least 1 year. For investors, you want to focus on long-term costs like roof, plumbing, HVAC, electrical foundations. What you don't want to do is you don't want to skip the inspections to make the offer stronger or not negotiating after unexpected issues. Also, you don't want to hire cheap or inexperienced inspectors. Instead, use the inspection findings to request repairs or closing cost credits. Also, you'll want to bring a contractor to estimate actual repair costs and also physically walk the property because photos can hide reality. So even with a clean inspection, your loan is not safe yet, and most deals fall apart during underwriting. So the next step determines if you actually get to the closing table or not. So once your offer is accepted, your file moves into underwriting. And this is where the lender verifies everything that you claimed on paper and confirms that the property meets the guidelines. So they will verify your income, your assets, your reserves, your employment, the appraisal value and condition, also insurance and title. And this is the stage where deals can die because when the buyers weren't actually prepared or they weren't pre-approved correctly. So when it comes to the house hacking strategy, the lender must confirm that you will occupy the property for at least 1 year. And they may ask for a written occupancy letter and ensure that the property is going to be used as an actual primary residence. Now for the investor side, the lender will verify the rental income potential. They'll look at any leases, market rents, or appraisal rent schedule. They'll also confirm your reserves, and they'll review whether the property can financially support itself without owner income if needed. Now, what you don't want to do during this time is you don't want to start making large purchases or open any new credit during this process. You also don't want to move money in between accounts, causing unverified deposits. You also don't want to start changing jobs or income sources mid-process. You also don't want to ignore any lender conditions until the last minute. And what you'll want to do instead is actually freeze your financial life until closing day. So that means no new debt, no job changes, no big transfers. Also, make sure you upload requested documentation within 24 hours to avoid closing delays. You'll also want to ask your lender upfront for a condition checklist so nothing is a surprise later on. Now, even if underwriter approves you, you don't own anything until you close. And this final step is where small mistakes can still cost you the deal. So closing is where ownership legally transfers to you. So you will at this time sign the final loan documents, wire your funds, and receive the keys once funding is complete. Now, after closing, with the house hacker strategy, you will move into the property and begin preparing if you did have other units for rent. If you went the investment route, you'll get the home rent ready as soon as possible, list it immediately. What you don't want to do is you don't want to not review your final loan documents for last minute fee changes, forget to start utilities and insurance in your names, and also not checking title deed transfers is actually recorded. What you'll want to do is meet everyone at closing, title agents, attorneys. These relationships matter for future deals. You also want to set your mortgage and insurance on auto pay from day one. Also, you want to immediately build your maintenance and reserve funds before you start collecting rent, because most people will never build actually real wealth, not because they can't, but because they never start. And real estate is the most powerful wealth building in history, and now you know exactly how to enter the market intelligently without guessing, gambling, or getting burned. So whether you start by house hacking or using a small multi-unit or buying your first dedicated rental, the most important step is really the first one. So don't wait for the perfect timing. The people who win in real estate are the people who begin. So if you want help running numbers, or if you need to know exactly how much your buying power is, click on the link in the description, schedule a call.